Do you consider yourself to be a strong investor or a weak investor? Hey everyone, we are back. We are back with another video about Thug Life, baby. This is a video today about Thug Life. No, I'm just kidding. We are here to talk about dividend growth investing. I get this question all the time. I am so grateful for the subscriber questions. Finally, I'm getting to this one. It is well overdue. I want to talk about bonds versus dividend stocks. And in particular, I think that bonds are weak. I think that bonds are weak, and I want to share why today. This is just my personal opinion, but I really do think that bonds are weak, and that's why I've got the glasses today. What are bonds? Let's just start with that. What is a bond? When one invests in a bond, they are investing in a debt instrument. They are providing a loan typically to the government or to a local city, to a local municipality, or even to a company. And in return for the loan, they get regular interest payments. And at the end of the loan, at the maturity date, all of the principal is paid back along with any outstanding interest payments. That's a bond. A stock, by contrast, is when one actually owns equity. They own a piece. They own a piece of an operating business. And so bond, literally giving a loan, loaning out debt. Stock, own equity in a company, own a piece of the business. I very, very much prefer stocks. I really like stocks. I'm going to go through the reasons today, especially dividend growth stocks. That said, I actually have a retirement account from one of the old jobs that I used to work with. And in that retirement account, it's a retirement account, so there's a different tax situation there. I actually own a bond mutual fund. And I'll tell you, the reason I own a bond mutual fund there is honestly the other mutual funds were such bad selections that it's really the only thing that I could find in there that I felt somewhat comfortable with. And so there is a time and a place for a bond, but for me it's usually a kind of last resort kind of thing. And whenever there's a better option, such as an S&P 500 index fund at the bare minimum, or even better, dividend stocks, I am all for dividend stocks. But that being said, there's a time and place for both, so I'm going to be fair here. I'm going to go through both of them here. First and foremost, let's just look at the yield. If you've been following my channel for a while, you know I invest for dividends. I invest for cash flow, and so I love yield. Let's look at yield. 10-year Treasury right now, 10-year Treasury bond from the United States government, loaning money to the U.S. government, 2.871% yield. Real low. Current yield on a stock I own, General Mills, ticker symbol GIS. I am buying this stock regularly. I continue to buy this stock throughout 2018. I love this stock, and I'm so happy that it's kind of lingering at these low prices because I keep adding more. 4.3% dividend yield. So off the bat, you can see apples to apples, one can receive a higher yield with a dividend stock. Quite frankly, we'll talk about this later, but this is actually not even apples to apples because the Treasury, the 10-year Treasury carries a higher tax consequence. There's more taxes owed on that interest versus qualified dividends with General Mills, and so it's even better than it looks here, but that's point number one. Point number two, bonds. Assuming someone holds a bond to the maturity date, to the date when the bond matures, there's really no upside. There's no equity, if you will, participation in the upside of the company that one is loaning the money to, or the government if one is doing a government bond. By contrast, with dividend stocks, one owns a piece of the company. So let's look at General Mills. Just in the last 5 years, the quarterly dividend went from 38 cents a quarter to 49 cents a quarter. Last 5 years, it went up 29%. 29% dividend growth in 5 years alone. And this is for a company that a lot of people think have hit hard times now. I personally believe it's a great buying opportunity, and that's why I continue to buy in at 2018. But it doesn't end there. There's a capital appreciation opportunity too. Because I own a piece of a company, as the company continues to do well, grows over time, I get some capital appreciation, meaning the value of my equity above and beyond the dividends can go up. With a bond, again, I'm assuming no trading here because I'm not a trader. I'm a long-term buy and hold investor. If I go into a bond hypothetically, I would just buy and hold. And so I wouldn't be looking to flip it or try to trade it. And if I buy here and I hold till maturity, I'm not getting any upside there other than the interest payments that come along the way and then getting my principal back. And so we talk about inflation here sometimes. I personally think a lot of people get worried about inflation. I personally think it's a non-issue. But if you believe there's inflation and it's somewhere around 2%, boy, 2.871, that's not good. That's not that much above inflation. Personally, I don't look at inflation. I'll link in the description below. I have videos about that. I have a video I want to share with you why I think inflation is kind of a non-issue, for me at least, but I have a really unique perspective on that. So what else about bonds versus dividend stocks? I think here, let's just talk about a case where a bond might make sense. If someone has short-term money, it's parked maybe for 3 years, 5 years. Oftentimes participating in the stock market for only 5 years, look, that to me just doesn't make sense. Their stocks are so volatile inherently that if one was just parking money, maybe bonds would make more sense. So I look at bonds as more short-term parked money, stocks as long-term financial independence. This is important. In my humble opinion, it is going to be very difficult to achieve financial independence as an investor in bonds. I'm talking about financial independence, financial freedom, when cash flow that comes in covers all of one's living expenses or the vast majority of one's living expenses. Doing this with bonds, especially treasuries, or even corporate bonds that are just low-yielding corporate bonds. Corporate bonds have a variety of ratings, by the way. There's these rating agencies like S&P and Moody's that rate them as like AAA, triple B, different letter ratings, and usually when you go from A down the food chain to B, C, D, so on and so forth, the quality of the yield is lower, and so usually the yield is higher because there's a higher propensity that the company may default on the bondholders. And so bondholders are rewarded for taking on more risk. But typically I would be at the top of the spectrum, just as I am with dividend stocks. I like premier quality dividend stocks. And with bonds, I would like premier quality bonds. And so anyways, short-term parked money, there's less risk with a bond, especially if one goes with like a AAA corporate bond or with a government bond. The trade-off here is I just don't see how someone's going to be financially free with bonds. And quite frankly, they're just not that exciting. Short term is the key word here. Bonds are just that, short term. There's a maturity date for bonds. They mature, and when they mature, one has to redeploy the money. And let's say interest rates are going down or they're flat. Let's say they're going down. Let's say one has a really sweet, like high interest rate bond. It matures, and then they have to find another bond to invest in, and there just isn't such a good opportunity at that time. Well, suddenly that person is going to forego that income that they were receiving. Whereas with a stock like General Mills, literally I can buy and hold this thing forever. I am in it forever. That's why I'm underscoring long term here. And look, no one's going to get wealthy overnight in General Mills with a 4.3% yield. But if someone buys it, they continue to increase the dividend by 29% every 5 years. And let's say someone holds it for 20 or 30 years. That's a different story. And that's the difference between holding for the long term forever versus being in these bonds where they mature and then you have to redeploy the money. And maybe you can't get as good of an interest rate and you're not enjoying those compounding effects because the interest rate is the interest rate that one gets when they lock the thing in to begin with. That's why if one is really long-term oriented like myself, they're looking towards the long term. They're looking for long-term financial freedom. In my opinion, there's just a non-comparison. This is why I call bonds really weak, real weak in my opinion. They really have this use case for the short run, but otherwise for the long run, just real weak. What else? Less risk, more risk. It goes without saying stocks have more risk, but the longer one holds, especially if you're looking at decades. And here's the thing. You hear a lot of pundits, talking heads on the TV here these days in the finance space talking about, oh, stocks are so risky. And maybe they can be, especially if one is looking at like a year or 5 years period. But if you're like me and you invest for 30 years or more, forever really, I look to never sell. I look to hold stocks generationally. The risk really starts to go away. And so I think less risk, more risk. Certainly in the short run. In the long run, quite frankly, I don't know. Maybe this is more risky just because am I even generating enough cash flow to overcome inflation? Am I even generating enough cash flow to compensate for what I'm doing, for the exercise I'm taking here? Quite frankly, when I have short-term money, I have that one exception in my retirement account, like I said, just because I couldn't find any other good options. And that's the thing I hate about some of these retirement accounts is there's just such limited options. And bonds may make sense in a retirement account just because we'll get to taxes later, but in a tax deferred or post-tax account, the interest payments can be paid and one won't owe taxes on them at that time. Taxes are in a 401k when one starts taking distributions, or in an IRA, taxes are paid before the money goes in. So bonds start looking a little bit more attractive in a tax advantage account. But that being said, my core strategy is not in tax advantage accounts. It's in normal individual accounts. And the reason for that is I want the opportunity to tap into my cash flow immediately. What if I want to use my cash flow tomorrow to pay for stuff? I want to be able to do that. Can't do that with a retirement account because I have to wait till retirement age. And so anyways, that's another nuance of all of this, is just account. How is the investment held? Let's move on. So debt versus equity, we talked about this. Bond is a debt instrument. Stock is an equity instrument. I always like having equity. That being said, something that everyone should know, let's say things go really bad at a company. Typically, bondholders have the first right to the company's assets. So let's say the company goes bankrupt. There's kind of a waterfall. There's a chain of command, and the bondholders are always higher up on the totem pole than the equity holders. And so the fact of the matter is, if a company goes bankrupt, the bondholders are more likely to get some of their money at least back than the equity holders. And so that's something to be considered. It goes back to debt versus equity. It goes back to less risk versus more risk. How I compensate for this, and I get a lot of comments, Ian, you own too many stocks. Well, do I really? I feel comfortable with the 38 stocks I hold, and I like having 38 because if one of them goes bankrupt, I really don't think that will happen because I'm a pretty good financial analyst and I have a pretty good track record of selecting companies here. And you've seen, people have been following me on YouTube here, my subscribers have seen some of my recent strategies in action, and I think the results speak for themselves, but I've been doing all right. And the fact of the matter, though, is it's just worth noting that, hey, if one is really risk averse, has trouble sleeping at night, is worried that companies are going to go bankrupt, is worried just about their finances to that level of degree, well, maybe bonds could make more sense, just because if a company does go bankrupt, the bondholders have the first right to those assets and to get their money back versus equity stockholders. So I think bonds, they're kind of more weak, stocks are more strong. And one has to be strong. I did a video about this. Investors and dividends especially have to be tough. I'll link in the description below. We have to be tough because what we're doing requires decades. It requires persistence, dedication. It requires going all in oftentimes during bad times, during bear markets. It's a lot harder, in my opinion, than buy low, sell high investing, or AKA trading. It's a lot harder than bonds. But the question I ask myself all the time, or I'd ask you to ask yourself, is do you want to go through life being a weak person or a strong person? Do you want to approach your finances in a weak position or a strong position? For me, the downside of failure, it's so inconsequential in my opinion. We all have one life to live. If one does not take risks, if one does not go after their dreams, aka financial freedom, financial independence, if one does not fight for what they want in life, what's the point? You know, that's kind of where I come from, is bonds. It just seems like, okay, I'll have a bunch of bonds. It's not really going to get me anywhere. It's kind of fine. I get some cash flow, but is it really going to get me to achieve my dreams in life? Not really. And so I kind of look at that as the weak way out and the boring way out. It's just, why would one want to approach life that way? I don't know. It's just kind of counterintuitive to the way I think. And look, I don't like to take crazy risk. I don't like to invest in growth stocks, high growth stocks that is. I like dividend growth stocks, a growth stock that pays a dividend, that's growing the dividend. But I'm talking about like these high PE FANG stocks. I don't go near that stuff unless I see a particular value in one of them that pays a dividend. Apple might be one, for example, that I'd consider. But in general, I look at that as like way high on the risk spectrum, and I've taken risks before. I've invested in Bitcoin. I did really well. I'll link in the description below. But the fact of the matter is bonds, that's just too conservative. Look, I'm a reasonably kind of conservative investor, but at the same time, I like to take risks, go after what I want in life, and I think bonds, it's just weak. It's just weak. Anyways, let's move on. Taxes, I love this. I did a video on taxes. I'll link in the description below. I'll kind of say that this is a appendix. This is an appendix to that video. I didn't talk about bonds in that video. Bond interest payments are taxed as ordinary income at one's ordinary income tax rate. I'm talking about the United States here. Dividend stocks, when dividends come in, it depends what kind of company one owns, but from a qualified dividend, the type of dividend that General Mills pays, qualified dividends are taxed as long-term capital gains. It's a more favorable tax rate. So if one is investing in instruments, they want income to come in. Financial instruments, they want the income, they want to live off the income, they want to use the income to pay bills. Bonds are weak because there's more taxes owed. Now, the carve out here is municipal bonds, aka munis. If one buys like a California municipal bond, one can forego the federal income tax on that that income, that ordinary income. So that's kind of a separate use case. But what I would add is the interest payments on those bonds tend to be lower, so it already tends to kind of factor in those tax efficiencies into the very interest payments that one receives. And so again, typically with bonds, one is going to have more taxes. With dividend stocks, less. And with dividends, the assumption here is I'm buying and holding forever. I'm not talking about capital gains taxes here. I'm talking about taxes on the income itself, taxes on the dividend payments, the dividend yield. And so when I look at bonds versus dividend stocks, bonds, they're just not for me. Now, I don't want to completely put them down. Again, if one is very risk averse, just can't sleep at night. I talked about quality of life. For me, if I'm not taking some bold moves, if I'm not going after my dreams, if I'm not being a little aggressive, for me, that vastly lowers my quality of life. I think like, wow, I'm not going anywhere. I'm not taking risk. I'm not taking charge of my life. I'm just letting these valuable years slip me by. That's what honestly keeps me up at night. However, there's other types of people. Not everyone is like me. Some people might be like, look, I worked so hard for this money. If I see my portfolio in the stock market, I take some risk and I lose 30% of my money in 1 week's time because the market tanks, the Great Recession comes again, Great Recession number 2. I can't sleep with myself, I can't live with myself if I lose money. It's going to keep me up at night. Maybe that is the type of investor that would want to go into bonds and maybe some cash too and just stay out of stocks because it would keep them up at night. At the end of the day, for me, it's about analyzing one's goals, dreams, quality of life, all of that. For me, if the stock market tanked, I lost 30% of my portfolio value overnight, it wouldn't really bother me. I mean, maybe it would have in the past, but I've been doing this for such a long time. I've been investing for over 20 years. I would look at that as an opportunity. I would be excited. I would want to deploy more money because I get a higher starting yield on my dividend stocks. Lower share prices, yield goes up. And so for me, I would like that. I would actually almost hope for that in some ways, but in other ways I wouldn't, because if the stock market tanked that much, it means the overall economy is not doing well. It means some of the companies would have some financial issues, probably take some time for them to recover. So there's kind of pros and cons, but that's who I am. I like taking on that risk. It lets me sleep at night taking on that risk, knowing that I'm taking steps towards my goals in life. But if you're not like me, like I said, bonds could be real interesting. So I'd be curious, what do you think? What are your thoughts on bonds? Do you think they're weak like I do? Do you think they're strong? Do you like them? Do you not like them? Do you look at it just as asset allocation? It's nice to have a little bit of everything. I'll tell you, I owned a bond-like instrument. I did some peer-to-peer lending. I'll link in the description below. I got out of that. Another piece of the picture here is I believe in keeping one's financial life clean. For me, look, I already have 38 stocks, but if I add bonds to that, peer-to-peer lending, this and that, it gets too complex. Too much clutter. I like a clean house, not a messy house. And so for me, that's another thing. When it comes to asset allocation, traditional money managers might be, hey, have a little bit of everything. Well, for me, the way I look at that is it's just too much clutter. I just want to stay focused on my dreams, on my dividend stocks. But other people, you know, everyone has their own way of doing things. And so that's one way to look at it as well. But again, yeah, I got some bonds. It was really a kind of logical decision that it was the last resort. It's just that, boy, those equity mutual funds that were available in that retirement account are so bad. And hey, I'll go with some bonds. I'll get some interest, and thankfully a tax advantage because it's in a tax advantaged account. But boy, in a non-tax advantaged account with the core of what I'm trying to accomplish in life, boy, I just can't see myself going after bonds. And so thank you for watching today. Thanks for hanging in there. I want to thank you all. Actually, we just surpassed 12,000 subscribers. This is a real milestone. We are dividend investors here, cash flow investors supporting each other, and we are such a great community. I love the comments, the feedback, the questions. This is a video based on your questions, based on your feedback, so that means the world to me. And I'm not trying to put anyone down, by the way. Look, I have strong opinions here. I'm not always right. I'm right maybe for myself, but I'm just a very unique corner case in the world of personal finance. Everyone has their own goals. So if bonds work for you, you like them, more power to you. I love that. I wish you the best. And honestly, I pray for you, not that you need it, but I literally pray that everyone here on this community just does so great in life, whether it's finances, whether it's personal life, family, whatever it is. I want all of us to thrive, and I really care about everyone here on this community. So thank you for watching. Before I leave today, a friendly disclosure, full disclosure, I am long. I own stock in General Mills, ticker symbol GIS. 4.3% starting dividend yield. Not bad in 2018. Nice little stock pick, and I'm picking up this year. In terms of a friendly disclaimer, this is not investment advice. I am not a licensed investment advisor. Today's video is just for your fun and entertainment. I'm literally just sharing my journey here on YouTube for fun. If you want to go out and invest in the stock market or anywhere else, bond market, please consult your licensed financial advisor first. Just some fun and entertainment here on PPC Ian. Hey, thank you. Keep the questions coming, the comments coming. I know I have had trouble responding to all the comments these days, but I try to read them all, respond to the ones I can, so keep them coming. And thank you to those in the community who are engaging and answering questions as well. Let's all support each other. And don't forget to check me out on Instagram. I will link in the description below. I'm there as well. I will see you in the next investing video.